It hasn't been a great year for hedge funds. They're down about 2%, but it has been worse for funds of funds. They're down 6%. These funds of funds are supposed to help investors be more diversified and ideally buoy returns in down markets. Of course, all for a fee. Maybe investors should learn to live without the middlemen. We partner with the FT to bring you Lex on Bloomberg so you can get a sneak peek at the Financial Times flagship column a day early. Ben McLannahan joins me now from Hong Kong. Ben, what do you think? Should investors learn to live without these funds of funds middlemen?
Well, it certainly looks as though they're learning to live without them in terms of inflows into funds of funds. At the end of 2007, which was the peak year for the hedge fund industry as a whole, funds of funds accounted for about 43% of assets under management. And now, according to hedge fund research of Chicago, that's down to about 34%. And part of that is because of this performance, which, as you say, just doesn't reflect the names of the funds themselves, like Mellon Sanctuary and Principal Absolute Alpha. These are supposed to be vehicles that guarantee returns a percent or so in all kinds of markets.
Ben, the Madoff scandal put a spotlight on funds of funds because so many of the outfits that fed money into Madoff's operation were funds of funds. Was that a fatal blow to this industry?
Well, it was certainly a very big blow because the industry sold itself on its ability to sift the sheep from the goats and to protect the underlying investor from the kind of activity that Madoff was up to. So that was certainly a very damaging blow.
Now let's talk about what the prospects are for this industry. Can it come back? If it's going to come back, does it need to perhaps cut fees? A traditional hedge fund charges 2% management fee, 20% performance fee. The funds of funds add another 1 and 10 on top of that. Is that just simply too rich?
Yeah, well, it's certainly too rich in view of this performance and in view of the fact that talent is leaving the industry as the assets under management shrink. This is a critical moment for the industry.
So what do you think is going to happen if leadership is going to emerge? Where is it going to come from? How does the fund of funds industry persuade institutional investors that there's value here?
Well, this is the big problem. It's always relied on this lazy capital that David Svensson of Yale was describing last year when he described funds of funds as a cancer on the institutional investor market. He described them as facilitating the flow of ignorant capital. And I think that's hit home at a lot of pension fund managers. They've realized, hold on, if I can't trust myself to select a hedge fund manager, how can I trust myself to select a manager of who's going to select a portfolio for me?
Ben, here's a little crystal ball question for you. If, in fact, the funds of funds industry does not bounce back, does not restore the reputation that it once had, will that ultimately cost the rest of the hedge fund industry inflows in as much as some people have been directing money to hedge funds only through funds of funds? Would they be unprepared to invest directly?
Well, I don't think so. It's not necessarily as bleak as that. If you look at the hedge fund research data I mentioned before, they've shown a net increase in hedge funds, individual hedge funds, so far this year. But funds of funds, as a subsector of that industry, have been liquidations have outstripped launches for the past 7 quarters. So there is an appetite from investors out there to invest in very intelligent, smaller funds that that they can generate some pretty good returns.
Well, Ben, as you and I both know well, the questions have long been asked whether those funds of funds really earn their 1 in 10. As you've been pointing out, maybe the answer is not really. That's Ben McLannahan from the FT's Lex desk.